Hi everybody, welcome to today's video. We're going to talk about the relationship between the US midterm elections and how the markets behave after the midterm election. It's a startling statistic. When I first read this, I said it can't be true. It's going back all the way to the Second World War that one thing has happened every single time. Okay, so let's get into some of the information. Okay, where are we today? This is the S&P 500, the Dow Jones, the NASDAQ, and the S&P TSX. The S&P TSX is actually that yellow line. And that red line that you just saw go across the screen represents the high in the S&P TSX in February, March of 2020, just before COVID hit. And I wanted to paint that in there for you so you could get a sense of where are we today. Are we still above the high of 2020? Has my portfolio degraded all the way back 2 years? And yeah, sadly, that's what we're seeing, right? We're seeing the S&P TSX not that far above the high of 2020. And so that's important to know because one thing right here, the midterm data is clear. Since 1950, there have been 18 midterm election cycles. And in the 12 months following each of the cycles, the stock market has had a positive return. That is that secret thing that I'm talking about. It's not so secret, it's a data point that's always been there. Can you believe that? That since the Second World War, 1 year after a midterm election, the stock market has always been positive. Now that is really remarkable given the fact that so many people are talking about doom and gloom. The worst financial correction is upon us. This is not what history is telling us. So let's dig into this a little bit deeper. Here are all the years that we've had midterm elections, and look at this. After 1 year the average 1 year total return was 18.6% after a midterm election. Look at all these data points going back to after the Second World War. If we're looking into it a little bit differently, we see that 6 months following a midterm election, the market was up 16%. 12 months, it was up over 18%. And 2 years after an election was 33%. Now, what's really cool about this is that we might be seeing a remarkable shift in the power. So let's have a quick look at, there's your current president, Joe Biden. His approval rating is 39%. I'm putting that on there because of a specific reason. You're going to find out here. Okay, so why does the market tend to go up after a midterm election? Because when a midterm election happens, there's a power shift. Usually, there's a significant number of seats that shift from red to blue in the United States. And I know we're Canadian, but you know what? What happens in the United States dramatically affects us here in Canada. So investors typically think that when there's gridlock, meaning that it's more of a 50-50 split, that there'll be less legislative risk, meaning they won't be able to pass too many things, and it'll be able to just carry on with the business of the day and have very little interference from the government. So people get excited about this and the market goes up. The second is lame duck president. Now, lame duck president refers to a president in his final year of the 4-year term. But because of what I believe is going to be happening next week, and keep in mind they might tell us that it's going to take 2 or 3 weeks to find out the true results. But the idea here is that because of the massive shift that I think is going to happen, is that the Republicans are going to win big time, that this is going to extend the lame duck president, not just 1 year, but 2 years. I believe it's going to be very difficult for Joe Biden and the Democratic Party to get anything passed. And why? Here's the reason. Look at this statistic. Since 1946, when a sitting president's approval rating is greater than 50%, the party loses on average about 14 seats. So there's still a shift, but it's not as dramatic as if the president's approval rating is below 50%. When that happens, on average, that sitting president's party loses about 37 seats, which means this would have a massive impact on who's going to control the House and also the Senate, in which case it looks like the Republicans might have a majority. And that's going to make it really hard for the Democrats to do anything aside from maybe executive order, which means that there tends to be more sentiment on the of markets moving forward when the Republicans get into office, as opposed to what's happening right now. Now, I'm not saying that the Democrats are the reason why the markets are so low, but there's some pretty good evidence as to why they're low right now. A Democratic United States party right now is driving up inflation rate, or driving up interest rates, and just signaled, so Jerome Powell just signaled that he expects to have the interest rates to go a little bit higher than what they expected. So we're all somewhere around the 4.5% range is what we thought we'd end the year at, and now they're talking about maybe going into the new year with even a higher rate. And that kind of idea has many economists around the world thinking the United States is missing the mark. They're overshooting the mark in terms of raising rates, and that it'll actually cause more damage than good. So this is a little bit of insight, at least, is that we might get some help here in the midterm elections to cool that idea of raising rates because of the power shift that's about to go on. Well, where are we with interest rates? Here's the Canadian interest rate forecast. You can see that in 2023, they're expected to be still quite high, even going into 2024, that where it looks like it's close to 4%. And the US, this is their estimation. Look at that, up at least 5% going into the better half of 2023. So it doesn't look like interest rates are coming down anywhere anytime soon. Anyway, I hope that was helpful for you. This is the kind of information I like to share, real data points. You get to make up your own point of view as to what you think is going to happen with the economy. I really hope that this is the case going forward. You know, having high inflation and high interest rates is the one thing that could stop this statistic of since the Second World War that we've had a positive market 1 year, 2 years after a midterm election. I hope this doesn't affect that. I really hope that we get a continued statistic that's going to drive the markets forward. We're going to find out in the next few weeks what's going to happen with the US economy, because we're going to be moving into November and December, where they have another rate hike in December, and then maybe in January we'll find out. But I'm really crossing my fingers for everyone out there that I believe that we are near the bottom of the market, and we're going to be seeing this market turn very shortly. I hope this was helpful. I look forward to seeing you in the next video. Hey, remember to hit that like button and also that subscribe button so you can see my next videos. Thanks very much for sharing the time with me today. I look forward to seeing you in the next video. Take care. Bye-bye.